Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans. In my previous commentaries, I stated how the influence of the, let's be frank here, optimized February to October 2021 head and shoulders top neckline, currently at 1228, ought to not be underestimated. Initially, it had been a tempering effect on earlier moves down. Then, it became a disrupting effect on the speed of the move lower, even though the neckline itself is bearish. Finally, in mid-December, it became a springboard for a move higher. However, this move higher could not have been achieved without the help of another important pattern, the September to December 2021 lopsided diamond bottom pattern that you can see in the middle of the chart. I had spoken of this pattern before, mainly as a suitable counter to the monthly key reversal down seen in November. Yet this bullish counter to an overly bearish pattern had turned out to be so much more. Prices broke up and out of this pattern in mid-December, breaking up over the resistance of the medium moving average, currently 1292, at the same time. We then saw a straight run up to the long moving average, currently 1326, where we saw some hesitation at the end of 2021. However, prices broke up over this resistance and converted it into support at the start of January. The market needed this support as it was moving up to test the important 50% Fibonacci line of the December 2020 to May 2021 move at 1405. Last week, prices punched up through this resistance and also converted it into support this week, as they now start looking at the late June to early July highs at 1459 to 1460. This is where we are currently testing. In this process of moving higher, prices easily attained actually, target X at 1370, the target for the diamond bottom pattern. So where are we now? Well, we have a potential, if increasingly looking like a short-lived bull channel of sorts, currently 1375 to 1454. You can tell from my language I suspect the market may be taking this upper channel line apart. Beyond that, we have the 2014 high at 1522, which would seem a reasonable point to look to topside. Meanwhile, below, we have the previously mentioned 50% Fibonacci line at 1405, the flatlining long moving average, and obviously the lower bull channel line. Now, this segues into the final observation. We had a golden cross, the rising short medium moving average, currently at 1322, moving up over the very slowly rising medium moving average, currently 1292. No other major patterns are self-evident at this time, but you can be fairly certain that will change here. Chicago soybean meal. The key feature here, and one that has been evident here since late November 2021, is the October to November 2021 bullish Andrews pitchfork. The upper tine, currently 455.20, has capped the market throughout, with the middle tine, currently at 429.60, acting as both support and resistance, and the lower tine, currently at 404 even, acting as support, but getting broken last week. So, why have I still kept it on the daily chart after its evident breaking? Well, just below the lower tine, we have the 50% Fibonacci line for the whole of 2021 at 390.40. And it is this that has stopped a full exploitation of the break below the lower tine. Indeed, we finished yesterday with a bullish engulfing pattern. Now, I am not so naive as to believe that prices will once again move back within this bullish Andrews pitchfork as if nothing had happened. At least I don't believe such at this time. Instead, I'm minded to look at the action as likely to move up to the underside of this lower tine and run along it, using the tine as an echo of the former pattern. There is still the possibility that the market may move back up within the pitchfork, but perhaps not just yet, if at all. Looking topside, well, we do have the declining January 2021 to date downtrend, currently at 425.70. Now, before you start questioning it, I know it is slightly optimized. I'll grant you that. But I think this is still valid. Meanwhile, below we have the rising short medium moving average, currently at 380.70. The 50% Fibonacci line, the August 2020 to January 2021 move at 376.60. And the ever so slowly dipping long moving average, currently at 368.10. Whilst on the subject of moving averages, I note the lagging indicator of the golden cross of the short medium moving average up over the medium moving average. That's currently at 357.70. I say lagging, but it was very timely, as it happened at the same time as the market pushed up over the long moving average and the 50% Fibonacci line at 376.60, and was therefore no doubt involved in the push higher. Chicago soybean oil. The recent major feature here is the mid-December to date bull channel, currently 59.97 to 65.15. The upper bull channel line was in operation by late December with what looked like a closer than now lower bull channel line, which is currently at 62.85. You can see it running through the middle. However, the well-publicized, and well by me anyhow, congestion between 57.65 and 59.45 dating from 2011 and 2012 slowed and seemed to slow and stop the rise in early January. All this was complicated and added to as well as resistance by the short medium moving average, currently 57.83, the medium moving average currently at 58.49, and the long moving average currently 60.43. Eventually, it was only Tuesday last week's move up over the long moving average that wrenched the market away from the grip of the congestion and established a new, wider bull channel. Since then, we've moved higher within this wider bull channel. And interestingly today, over the October 2021 high at 64.31. The next congestion is in the 66.45 area, which ties in with the late July high from last year, as well as an actual high on a two consecutive closing basis of the same July period, and that's at 67.78. We have no other major patterns operational this time, but though I am mindful I could draw a bullish Andrews and bullish shift pitchforks for December 2021 to January 2022 action. However, I choose not to, as these would be very, very narrow pitchforks and likely to be of limited use, perhaps only good for timing, and with no better levels that the bull channel itself already there can offer. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.